I'm 78 years old. I'll be 79 in August. I intend to keep working for another 8 or 10 or 15 years. I'm in good health and I feel good. I do well and I love what I do. But at the same time, I'm probably not going to work for the next 40 years. Maybe Chris will. I will work for part of that time. So we want to talk today about the transition and what's going on. I've been in this business for 36 years. And in years like this, it feels like I've been in this business for 120 years. But there's a lot going on in the idea of transitioning the business. I thought it was going to take 5 or 6 years to pass a lot of knowledge. But what's happened this year is probably in the last 5 or 6 months, so much has gone on. And we're going to talk about that today. So much has gone on that they've probably gotten 5 or 10 years of knowledge in 5 months. So we're going to talk about that. We peaked on the 4th of November, and the market has continued to go down. It's kind of like 1987 in slow motion. It's been like the Great Recession in many aspects. But it's taught us a lot. So I'm going to let Al and Chris talk some, and we're going to carry on a conversation about some of the things that we've learned. I don't think you would have learned that without this kind of market.
And just kind of piggybacking off that, Mike, it's during the good times, we've been in essentially the longest secular bull market in history, right? Yep. And it's been nothing but up. If you're invested in the market, you're probably going to do well leading up into this point. But now that we're our feet are to the fire a little bit, and we've had 5-6 months of downturn, and it looks like we're in our first bear market. It's funny. It's funny how everything changes. There's what you do in the textbook. There's certain things that make sense on paper, but when you're actually living it day in and day out, you're getting those angry phone calls. People are freaking out. Everyone wants to go to cash. The ball game changes.
It does.
Yes, it does. I mean, I just had a conversation with a friend who's potentially going to become a client, and he calls me on a Saturday morning, him and his wife together freaking out. They want to sell everything. The stocks are going down. We're going to pay off the house and be done with it all. I'm trying to talk them off. I'm going, okay, just tell me more. And I said, let's slow down and rethink this, And it's really interesting just to kind of peel it back and just hear from people how crazy they get when things go like this.
And from a younger perspective, a lot of individuals that are, in my, millennials, I would guess you would say, they've enjoyed investing for the last 3 years. A lot of them have downloaded Robinhood accounts. They have the Thinkorswim. They have a bunch of different, platforms that they can use to trade on their smartphone. And now, in the last 6 months, it seems that all those gains over the last 4 years have seemingly dissipated, and all of a sudden, people are a lot more receptive to financial advice. They want to know what we're doing. They've come back to reality a little bit. And it's times like this that they need the professionals.
Talking about being professionals, you've seen some things in the last 6 months, which I don't think most financial advisors, no matter how long they've been in the business, really understand or know. You've gotten to see that, market makers.
Yeah. I mean, it's kind of like where do you even start, with everything that I've learned. It's, these downtimes are when you learn the most, but, specifically market makers and the relationship with that and the exchanges and really when you press that submit button, where does your order go? What are the inner plumbings of how everything works? And that's something I've been learning quite a bit about. Me and Al have been working quite a bit about.
Yeah, I mean, we've talked about it before on the show. We talked about market makers. We talked about high-frequency trading, right, where things go and who gets paid on the way. We've talked about Bernie Madoff and how he was a market maker. It's interesting in this time to see what how they hold inventory and what goes on.
Talking about the inventory, so we've seen it happen multiple times this year when a stock misses earnings, or even if they've beaten earnings, and there's something that happens, and a stock gets sold, and not not just a full day, but it could be 17 or 20 days. What have you learned about that?
Is that analysts in these, they don't always have it right?
No.
How many?
No, I want to talk about market makers.
Okay.
What happens with market makers? Who buys the stock? If somebody's selling and the stock drops 30%, who buys the stock?
The market makers.
Yeah. And if you have a big sell-off, maybe a stock is trading 10 million shares a day. They drop 30%, and it's no longer 10 million that's sold. It's 100 million or 200 million that's sold that day. Who's the buyer? We've hit a dead spot. Maybe we didn't learn that much. It's the market makers that buy that stock. So they're sitting with an inventory of 100 or 200 or 300 million shares. Market makers normally want to clear their books at the end of the day, but in order to be a market maker, you have to guarantee that you will make a market in the stock, that you will buy anything that's sold. If there's not buyers, you will short anything where there's more buyers and no sellers. So they're sitting with a stock that normally trades 10 million shares. They're sitting with 200 million shares. How do they clear their books? What happens?
Yeah, ultimately, it's in the price of the stock that they're in their bids and asks.
Yeah, they have to drop the price to where they believe they're going to bring that inventory in. If the stock was selling at $200 a share, when it drops off and it drops down, the market makers will set the price at which they want to buy the stock. They're willing to buy 200 million shares. And with that, they will bring that in. And then on the following days, they will move that stock and let people buy at 142 or 145. Mm-hmm. So their whole purpose in making a market is that they want to set a price where they're willing to buy this stock, and they feel that they can sell and over the next 20 or 30 or 40 days, how many days it is, that they can sell that stock at a bit of a premium to cover their cost.
You know, and especially when going back to the volatility that we had talked about, an interesting article that I saw was that the market makers act kind of like a pilot does. Yes, the plane could take off by itself and land by itself, but when there's increased volatility, it's important that the pilot takes the plane off and lands it itself, right? Well, in the same way, a lot of these market makers are doing the same thing. We see a lot of volatility in the first hour of the trading, and typically a lot of this is handled by computers. But during that first hour, when there's increased volatility, we actually notice that a lot of the exchanges are manually taking care of a lot of the trades and setting the bids and asks instead of just routing it all to the computers. And then we see the same in the last hour of the day. And that's why a lot of people who don't realize the 2 hours of the day that you're going to see the highest trades, the most exchanges of the trades are going to be the first and last hours of the day. And it's, that's one of those things that I never really picked up on. And while the middle of the day is essentially going to be autopilot, so to speak.
And that's a reason, with that going on, with the sell-offs that are happening, we've been able to see that in these past 5 months, and you'll get used to this. Sadly, it won't be the last time, but at least you'll know where things are going, and you'll know that the price is not going to increase until that inventory is gone, because there's a huge amount of inventory that the market makers are waiting to get rid of and get off their desk. Once they've gotten rid of the inventory, then the price is going to do whatever the price is going to do. But for a certain period of time, and it's not an insignificant amount of time, 10 days, 20 days, 30 days, they are getting rid of their inventory. And so when you know that, that gives you an advantage, which very, very few financial advisors have. Very few people in our business really understand. I've been around 30-some years, and I've seen it happen again and again and again. You'll see it happen again. So this is a learning experience. can talk about it all we want to talk about it, but until you've gone through it, until you've seen it, you don't know.
Yeah, and until you have to, respond to angry phone calls, you really don't understand. A number of months ago when I was on the program, I had talked about the GameStop frenzy, the meme stock frenzy, and ultimately how, in a lot of ways, it hurt the retail investor, the person that that's on their phone trading. And one of the interesting things that's going on right now is Gary Gensler, the SEC chairman. He has a heart for the retail investor. He has a heart for individuals that are at home, trading. And he wanted to make a change after this frenzy. He knew he wants to fix things. And so out of this rally, what we've seen is that if you were to download Robinhood and start trading, there is a 90% chance that the positions that you're going to trade are either going to be directed to Citadel or Virtue Financial. These are clearinghouses. These are the ones that actually handle a good chunk of the trades. Well, every time there's a trade placed, Robinhood actually gets a little bit of a kickback from these clearing firms because when you're directing all of your trades to them, it makes it more efficient. Well, during these frenzies, when people were not allowed to or not able to sell out of any given position, AMC, GameStop, whether it be a crypto, right? It caused this frenzy, right? And this is all stuff that we've talked about. Well, what Gary Gensler is proposing is to go back to a format that we used to have, and that's where every time there's a trade conducted, it goes to auction instead of being routed to a specific clearinghouse. And so what this does is when you're forced to send every trade out to a auction, like a primary auction, ultimately the idea is that it's going to become a lot more competitive. Now, obviously, these clearinghouses, the Virtue Financial, Citadel, they're strongly against this, right? Because no longer are they going to get spoon-fed orders. Instead, they're going to have to go to a public marketplace, and essentially there's going to be a lot of bidding on it. So there's a lot on this. I covered the high level, but it's interesting, Mike. We talked about this in the office earlier. It's interesting because this sounds like the way that it used to be.
It used to be that way. It used to be when I was with Dane, there were three guys that sat in an office. Dane was making a market in a couple stocks, and they would trade stocks. And in the old days, the margins were a lot higher. They were dragging 1/8 of a point or 1/4 of a point for the stocks. And so they sat there all day long, and they made a market. And they had to offer to buy 1,000 shares or sell 1,000 shares of each one of the stocks they were dealing with. And you had an office in Seattle, you had an office in Minneapolis, you had an office in Denver, you had offices all over, and you had probably a dozen other small operators in Seattle, all doing exactly the same thing. And so through their collective efforts, people would get the best buy and sell. Now with computer trades and with the kickbacks that are going to the firms, that's not happening. You've closed out all the small guys, and you have a few firms. And in order to keep themselves in business, they're paying half a penny or 1/4 of a penny or a penny per share. Mm-hmm. And when you're trading 300 billion shares a day, a penny a day adds up
very quickly.
And to $3 billion a day that's going to the brokerage firms. And who's paying that? Yeah. The retail investors.
Well, the argument is, from the clearinghouse, the Virtue, the other side, they say that this is the only way that they can now offer zero commission trading and give them the best possible, provide, what do they say? I'm looking at the article right now. It says, provide the better prices than they would if their orders were, on a primary auction. And I just have a hard time believing that.
So our custodians, Interactive Brokers doesn't direct anything. When we do trades, mm-hmm. we direct where it goes to. I direct where it goes to. You direct where it goes to. Mm-hmm. That trade is a directed trade. There's no kickback. There's nothing that comes to us. Interactive Brokers was the one that launched the zero commissions. If they're not getting kickbacks and they're doing zero commissions, yeah, they're making their money other places.
Well, you saw what happened when TD Ameritrade and Schwab finally merged, right? They were all, remember they were in the fight to cut prices, right? And as soon as they merge, what do? They raise prices.
Yeah. So anyway, that's going on. I think it's a positive for the clients, for the retail clients.
And I think that's just one of the ways that things are changing right now. So it's important to have a grasp on the way things were and then how they're changing as well, because, it's nice to be in a position now where everything, you're learning everything for the first time. You can, I'm a sponge right now. I'm not set in my ways.
So I want to shift gears and talk about Analyst. Al, you have some input on that.
Analyst, yes, they're notoriously wrong.
Can you trust them?
So how do they get paid?
They get paid by they get paid by the companies of the stock that they rate.
No, they get paid by commissions.
Yeah.
In their stocks. They get paid they get paid a salary, and they get paid on how well their stocks perform. They also get paid if they bring in IPOs or mergers and acquisitions. Of all of that, the smallest part is their salary. I can remember during dot-com times, people were making so much money, analysts were making so much money on dot-coms. I knew one of those guys who was working out of New York. His base salary was $100,000 a year. He was making so much money from IPOs and from commissions in his stock that he bought a condo, and the monthly mortgage was $150,000 every month. And when the dot-com crash came, he had a salary of $100,000 to get by, $100,000 a year, and a mortgage payment that required $1.8 million a year. So that gives you an idea of what's happening with their incentive and what they do. So with that in mind, talk about where they are with what they do.
Well, let's just take the 2000s, for example. In the 2000s, most analysts never predicted a negative forecast. All their forecasts were predicted were positive, which means they missed 6 out of the 6 years. There were 6 years where they had, from 2000 to 2018, where they had negative forecast, where the market was negative and they didn't predict it, and they missed the boat on 2008. They all thought 2008 was going to be a great year.
And the stocks that they covered, they thought they were going to do very well.
Yes. Yep.
I mean, although he's not an analyst, one of the most famous ones was Jim Cramer from CNBC, who somebody called in, and they do screen the calls. You never hear anybody on his call say, "You told me that I could buy that stock and it went down. You told me that I could do this." And anyway, you recommended I not buy something, and this stock has just soared. You never hear that. Every call that comes into Jim Cramer is positive. Every single one. And he made the recommendation that Bear Stearns was a table-pounding buy at $72 a share. There were analysts that also thought that. A couple of months later, it was at 2.
Well, Mike, it's important to remember how these analysts get paid, because ultimately that's the only silver lining that's going to tell you what motivates them. And I always think about this is, an analyst gets paid for correct recommendations one way or the other, right? And they're never going to make predictions that are in excess of 12 months, right? They're all going to be short term. So I talked about this earlier. If you were to take an analyst, you were to take him today, put him in a time machine, bring him back to the 90s. He knows today that Microsoft is going to be a phenomenal stock. It's going to go through the roof. But you put him back in the 1990s and you ask him to give a recommendation. He's not going to tell you, it's going to be trading at $300 and some dollars and change in 2022 with this many splits. No, he's going to make a very conservative recommendation slightly above the price, right? Because every time that hits, he gets paid. So for example, let's say an analyst had a buy rating on a stock and they expected the earnings per share to come in around 50 cents and the revenue to be $50 million for the quarter. Well, when they know that the companies beat the analyst expectations, the investors are going to react a certain way. So when analysts make a public prediction that a company will report, 45 cents per share on earnings and 47 in revenue, because these publicly stated, estimates are going to leave room for error and then some. So when the company then reports its financial results, it's more likely to beat expectations, and then that in turn would make the analysts some money. And so that's going to give their true opinion. So oftentimes these analysts aren't giving their true opinions; they're giving what is most convenient in the short term.
And that really happened during the dot-com time. When let's put lipstick on this pig and put it out there. What happens is people turn and look to analysts during times like this to see what the analysts are saying. And the analysts are as much in the dark about all this that's going on as we are. But there's a sense of positivity, a positive feeling that these people that are really involved closely with the stock know it better than we do. No, not true. And I do want to come back to it because I want to talk about a specific example and an analyst. When I was at Dane, I was really early in doing biotech stocks. 1986, I did my first biotech stock. And my daughter followed me into the industry, followed me into the biotech industry, and now does investor relations for a company in the industry. But by the 1990s, the biotech sector had really blossomed, and there was a stock that came out as an IPO in 1990, and I want to talk about that. I did biotech stocks. First one in 1886, but there was one that came out in the early 90s. It was a company called ProCyte. If you've been around a long time, maybe you remember ProCyte. They had a copper-based ionomin gel, or a copper-based gel called ionomin. It was set to treat plantar ulcers on the heel of the foot. They'd gone through animal trials. They'd gone through human phase 1, human phase 2, completed in 1992, and they were entered into phase 3 clinical trials. They do animal trials to see if it works. They do human phase 1 trials to see if it's safe, phase 2 trials to see what kind of dose, and phase 3 trial to see how well it works in comparison to a placebo. And they announced their phase 2 clinical trials in 1992 with a 2% gel. And the average closure rate with the gel was 67%. The placebo was minus 13%. Infections got worse. The ulcers got worse. They had fewer infections. They had 32% infections in the placebo group versus 6% in the treated group. And so they went into phase 3 claiming it was a double-blind test, which meant doctors didn't know whether the people were getting a placebo or the gel, and the patients didn't know. Double-blind. So there's a conference, a biotech conference, and I went with my daughter, and we looked at different breakout sessions. She went to the ProCyte. And during the ProCyte, she said, the copper gel has a blue color. How did you get a blue color in the placebo? To which they said, we didn't. The placebo was clear. Ionomin was blue. So what should have been blinded to the doctors was obviously not blinded to the doctors. What should have been blinded to the patients was not blinded to the patients. And as I looked at all that information, as I looked at the fact that the placebo group had 32% more infections than the treatment group, I couldn't see any reason for a gel to prevent infections. So I was actually on a call on Friday. On a Friday, I was the 6th person. There were 5 analysts, and those analysts believed it was a table-pounding buy. I had shorted this stock a few months earlier. I shorted it at around $10 a share, and by now it was $12, and they were saying it was a table-pounding buy. Listening to what they had to say was so depressing. I came in that was on a Friday afternoon. I came in on Saturday and went through the whole thing. It was pretty depressing. I thought I was really wrong. I thought about, do I sell? I'm underwater. My clients have lost 20%. Do I just close and take the loss and move along and say I was wrong? One of those analysts worked at Dane. And there were 600 or 700 stockbrokers at Dane who were long ProSite stock because it was supposed to be one of the big winners. So I was also feeling very alone that all of my peers were long the stock and I was short the stock. 5 analysts, the only 5 analysts that covered the stock say it's a table pounding buy, and I'm short the stock. So Monday morning, I'm thinking I've got to make a decision, but prior to the open, ProSite announced that phase 3 clinical trials did not work, and the stock opened at 2. My $10 short turned out to be an amazing. I was not very nice. I was out there screaming and yelling when everybody else was looking at having put people into the stock at 10 or 11 or 12 and that they take a big loss. But there's another point about it. The analyst at Dane got the news, as everyone else did, prior to the opening of the market at 6:30. And she came out with a recommendation to sell on Monday morning before the market opened. Before anybody could sell, this is before after hours trading. Before anybody could sell, she'd come out with a recommendation to sell. And her bonus on performance in the stock was based on the fact that the stock had closed at 12 on Friday. And before the market opened, she came out with a sell, and she got credit for the performance of selling the stock at 12 and the stock being at 2. She got a nice bonus. And everybody who she had recommended the stock to got screwed. But that's an insight into what analysts do. And so when you look at how analysts are rated, they get some really good ratings. You have to be very skeptical of it because of that. Not only are they wrong, as you mentioned, Al, on their forecast, but sometimes they know how to manipulate the system so they look like they're a whole lot better than they are. Mm-hmm. By the way, that analyst didn't last a long time because that was... She went on to work for Northern Trust, by the way. That's
funny.
Anyway, for analysts, you have to take it with a grain of salt. Yes, they do a lot of work and they come out with information, and some of that information is really good. It's worth looking at and reading. But it's also important to understand that they're getting paid a salary, which is nice. Their bonus is based on the commissions that they generate in their stocks. So it makes some sense for them. And because institutions actually do pay a commission on their stocks, and managed accounts pay a commission for their stocks, mutual funds pay a trading cost. So retail clients can do zero commission, but everyone else is paying a commission. The analyst get a bonus based on the commissions. So if they change their sale price or their target price, they induce either more people into the stock or they get people to sell the stock. And one thing that I always find interesting is when an analyst comes out and lowers the target price and gets a lot of sales and then comes out with a table pounding buy and raises the price, you got to let a few months go by. You got to figure out what your paycheck is going to be for the quarter and your year-end bonus. And what we learned in the dot-com time, were there a lot of dot-com companies that analysts had the connection to, brought to the company, and got paid finder's fees, which were a big deal. And when they get paid a finder's fee and a company becomes an IPO, they have the responsibility to follow it and generate commissions in that stock. So how accurate will they be? How very accurate will they be? Anyway, insight into Analyst and what they do. And talking about estimates, the other area in our industry that we deal with are economists.
Economists.
And there's a reason why Harry Truman said, I would really like to find a one-handed economist.
You stole my line, Mike.
You can tell the line.
Well, the funny part about it is, back in 1895, this guy Alfred Nobel started his Nobel Prize, right? And the Nobel Prize was in chemistry, physics, and a few other hard sciences. And it wasn't until 1969 that the Bank of Sweden, I can't think of the name of the old 300-year-old bank, decided to put this prize for Nobel Prize for economics, which the Nobel family didn't really want because it's more of a soft science. It's not really a hard science. Every time you mix two hydrogens and an oxygen, you get water. Every time you mix two economists, you get 6 different answers, right? So they didn't want that because I forget the economist's name, when they asked him to be on the board to try to help design this, he said no. And his reasoning was, he said, somebody should not be imbued with that much power because the lay people are going to take this as like chemistry or physics, that, it's an absolute, and it's not. I mean, just the last Nobel Prize given was on proving, they say so-called prove that that raising the minimum wage doesn't affect unemployment. Well, there's been plenty of other studies that have proven completely the opposite. So economists are it's not a hard science, and we put way too much emphasis on what their predictions are.
And their predictions can be off a lot.
A lot.
According to Nate Silver, who wrote the book The Noise and the Signal, the plus or minus on an economic forecast is plus or minus 3.2%. So if they forecast that the economy is going to grow at 2.5%, it could really turn out minus 0.7 or plus 5.7. So that's the reason why Truman said, I'd like a one-handed economist, so that they won't always say.
Well, he was so frustrated in a meeting because they kept giving him, literally saying, on this hand, and he just said, damn it, can somebody just get me a one-handed economist?
On the other hand, we'll come back right after this commercial break, and we will make it a one-handed response.
Switch over to behavioral finance. So basically, what you think you might know might not actually be true. As Mark Twain likes to say, it ain't what you don't know that gets you into trouble. It's what you think you know for sure that just isn't so. And that kind of encapsulates what behavioral finance, what we believe and see and perceive is not necessarily so. And the way people react to certain outcomes or events is based off of past performance, past experience, and those can cloud our judgment, especially for us who's sitting here looking for stocks. We have to be very conscious of those type of experiences that we've had in our thinking to not be clouded by, to make sure we're seeing actually what we're seeing.
Mm-hmm. And I joke that in times like this, my job is a lot less of a stock picker, an investment manager, and more of a financial therapist. And, the reason this is because, and Dalbar actually did a study on this. It's that the investor feels the pain of loss twice as much as they enjoy the gains of appreciation, right? And so what this means is that when you're up, you enjoy it, but when you're down, you feel that twice as much. And I think it's one of the reasons during these downturns, people freak out. Yes, we know over the long term the market has always gone up and it will continue to go up. Earnings, revenues, they've continued to grow. But when we're down like this, people feel this pain, and it's like the world is coming to an end all of a sudden.
They lose sense of reason. Like the example I gave about my friend Rich, is his name, and all sense of reason and logic out the window, right? They cannot see the trees through the forest, literally. Mm-hmm. And so they get one-track mind. And like that little presentation we sat in with Alliance Bernstein a couple weeks ago, right? The guy was saying that, and I remembered that when he called me, that you can't change someone's mind. You can't provide a solution when somebody's in that flow of mind because they're so focused on what they're in, the hole that they're in, that they can't see anything outside of that.
And it's like, do you really believe that the U.S. economy is going to, fall off a cliff and no longer be relevant in 10 years?
Yeah, I mean, everything's going to go to they literally believe. I've had people say, I've heard several times, everything's going to go to zero. I said, if everything goes to zero, we got a lot worse problems. I mean, so like one of those apocalyptic shows, I'm like, I could care less about that. If everything goes to zero,
it's never going to happen. I mean, is Microsoft, their buildings, their headquarters, those buildings are never going to go to zero, and therefore those assets are, and those are all on the books. Those are never going to go to zero. So I don't understand this fear that people have.
But it is a fear, and we see it again and again. I can remember being at a cocktail party where there was a woman who was not a client, never became a client, but she was saying that she had lost, with the dot-coms, 93% of her portfolio. And she was now just going to do CDs.
Well,
Not luck.
Those stories are out there, though, Mike. I have a guy that a friend introduced me to, and when I met him last year, he kept saying, yeah, I want to put some money, I want to do something different, I didn't know what he had, right? I didn't know what he had. And then after a conversation, he told me what he had. He had this one stock that he had bought, and he bought in 50% on margin. Someone got him in at the IPO price. It's this company, Global E. They're an e-commerce type company. He rode that stock up to $82. He was literally worth like $12 million. And he had one stock. I kept saying, you need to do something different. He wouldn't listen. Now he's down to he's below. He's probably had to cash out all his margin, And so people, when they get up like that, they think it's going to go. We think when the market's up, it's going to go forever, right?
Mm-hmm. Yep.
And when it's down, we think it's all going to go to the. It never happened, right? It never goes forever, and it's never gone to the bottom. So.
But it is that feeling. It's a feeling that you're walking through the jungle and the tiger's about to pounce. And our reactions are in the same way. We have, I think, Thinking Fast, Thinking Slow is a book that was written, and he talks about the two types of thinking. Thinking fast was the way we used to think, because when we were living in caves, you had to make decisions quickly. And even today, there's some decisions you have to make quickly. But a lot of decisions need to be made slowly. And if you have the wrong thinking, if you make fast decisions, but instead of thinking it through, you're going to make mistakes.
Yeah, that's back to my friend Rich again. I'll bring it up because his wife was so adamant. If they're feisty Italians, and they both of them, and they 100% Italians, and they both wanted to sell their 401ks, and I said, well, how are you going to pay all the taxes? What's going to be left? Oh, we didn't think of that. Was there another way to do it? Yeah, there's actually another way to do it, And so we went through a couple different scenarios of how to do it over maybe a time that you could actually do some of it and do it right. And it was really interesting to kind of you could, the temperature in the conversation in the room just started to go down once they got away from their original decision and started to really think it through, that was probably not the right thing to do.
I mean, when you're down like that, you're just locking in your losses. Mike, going back to your person, I mean, when you're down 93%, you decide to go to CDs, you are now going to be down 93 or maybe 92%, let's be optimistic, 92% for the rest of your life.
It might be 92 for 1 year, and then 91 the next year, and then 90 the next year, and then 89, and then...
then you're going to hit these times with inflation at 8%. We're going to go backwards again.
No, we live in a really strange time right now. And I'm not sure that we're not going to see the market much higher than it is today. but we're going to live through these times again. And part of what's gone on during the last 6 months is you guys have learned a great deal. You are learning a great deal. And that's going to make a huge difference as we go forward. You will remember the tough times when we have good times again. I think it's the four words in Ecclesiastes, which are the most fearful, the most feared, and the most treasured. This too will change. At the top of the mountain, it's going to change. At the bottom of the valley, it's going to change.
You go an Old Testament on us now, huh?
I am. I love the Old Testament. But anyway, that's another different subject. We'll have to come back to that on a different time.
If Mike starts talking to bushes, we'll know.
So anyway, it's been good to have you, the listener, with us. It's the three of us. We work well together. We've got a team working. We manage money, and in the long run, it's not about what's happening today or next week. It's when you get to 2024 and look back and think, I wish I would have. I wish I would have. That's when it really counts. So, we will be back again next week, and we'll probably be the three of us again talking next week, talking about a whole different set of things that we've learned from this transition period of this last 6 months. So don't miss it. And if you miss this part of this program or all of this program, you can listen to it again. Maybe I'm biased, but I think it's well worth it.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer.